As of late 2025, the S&P 500's year-to-date performance has been characterized by strong double-digit returns, sitting at approximately 16.3% price return, or 17.5% in total return. This level of performance is very good when viewed historically, as it significantly exceeds the index long-term average annual return of roughly 10%. However, a closer look reveals a story of an extremely narrow and concentrated rally, which introduces both excitement and risk. This chart strongly illustrates a divided US market. The market's strong overall performance is extremely narrow, driven almost entirely by the Mag 7 and highly speculative, unprofitable tech companies. The vast majority of the US market, including the profitable S&P 500 components outside the Mag 7 and profitable small and mid-cap companies, has been left in the shades, with very low or modest single-digit returns. This is a characteristic of a highly uneven and concentrated bull market. Going one by one, we can fully understand that we have Nasdaq with no revenues, which is the highest performer. This group of companies is flying, achieving a 41% average return, almost more than double than the next highest group, which suggests a strong appetite for high-risk, high-reward growth potential. Then we have the Mag 7, also known as the Magnificent 7, which is Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, are the second best performers, driving a significant portion of the overall market's return. Then we have unprofitable Nasdaq, another category of unprofitable tech companies that has performed very strongly, reinforcing the theme of investors favoring growth over current earnings. Next, we have unprofitable US small mid caps. Even outside the Nasdaq, unprofitable small and mid-cap companies have outperformed most profitable segments. Then we have Nasdaq with revenues. This group, while positive, has returned less than half of the Nasdaq no revenues, indicating that having some revenue is not currently rewarded as highly as pure speculative growth potential. Then we have the S&P 493. This represents the S&P 500 excluding the Mag 7. Its modest 7% return shows that if you remove the largest stocks, the broader US large cap market has been relatively flat. Then we have the profitable Nasdaq. This is a group of profitable tech companies that are among the worst performers, suggesting a rational shift away from value and profitability towards growth and speculation. Then we have the profitable small mid caps. These are the lowest performers. This is a group of the most fundamentally sound profitable smaller companies that has barely moved, emphasizing the highly concentrated nature of the 2025 market rally. The chart shows the disconnect from fundamentals and stock price for the majority of the market, which makes good quality companies to be forgotten. Most investors are piling up and betting into AI stocks, which reinforces this disparity. The extreme outperformance of companies with no revenues while profitable companies languish has raised concerns about an AI bubble, building up in the most aggressive corners of the tech and AI space. The market is clearly exhibiting a characteristic of rewarding unrealistic future potential over current sound business fundamentals. The chart illustrates a market environment defined by extreme narrowness, where valuations are soaring for companies with no profits or revenue, and capital is being mislocated based on hype rather than sustained profitability. This structure carries significant risk, echoing patterns seen in the prior speculative bubbles. Between all this hype, speculation, and blinded by excitement, you can still find hidden gems in the market, companies that are still growing fundamentally that can compound for years to come, but the market has not priced them in correctly due to the AI hype. So in this video, we're going through the two types of analysis needed in order to find those mispriced companies or undervalued companies. We'll have to do a quantitative and qualitative analysis. A qualitative analysis is a method that focuses on non-quantifiable aspects of investing research, like managers' investments philosophy, how their team is structured, or how they incorporate certain principles into their strategy. In simple words, how the company is evolving and expanding without mentioning numbers. Quantitative analysis, on the other hand, is all about numbers, the measurable data that you can use to dictate your assumptions, like the total return, the revenues, the free cash flow, the ROCE, and so on. For this video, I'll be using S&P Global as an example for both quantitative and qualitative analysis. For the qualitative analysis, you head to the company's investors relation and find the management's comments on current market conditions. They usually make a post about it or mention it on the quarterly earnings report. Remember that market conditions change from time to time, so the current market conditions are related to artificial intelligence. So beside the usual macroeconomic conditions, we need to find out if S&P Global is applying AI to its business. For the purpose of the video, I gather how S&P Global is implementing the current buzzword, artificial intelligence. 1. S&P Global acquired Kensho in 2018. It acts as an innovation hub that builds specialized AI tools that handle financial and unstructured data. Number 2. S&P Global is embedding generative AI directly into its flagship platforms to change how clients interact with data. They're increasingly focusing on agentic AI, systems that can automatically execute multi-step workflow rather than just answering simple questions. 3. S&P Global is leveraging big tech infrastructure to scale their data delivery. They have partnership with Snowflake, AWS, and Accenture. So S&P Global is a company that works with a lot of data, literally their bread and butter. So utilizing artificial intelligence to scale and increase margins is a good route to take. Qualitative analysis is more complex than what I'm doing right now, so this is a small example so you can understand the process. Moving on to the quantitative part, this is when we get into the numbers. We look at the fundamentals of the company to see what is going on with the business. When we look at the stock price year to date, the stock has stayed relatively flat. Despite adding AI capabilities to expand, the company's price has not been picked up by the market. If we zoom out to the 5-year chart, S&P Global is up 50%. Decent gains, but trailing the benchmark. They have no explosiveness like Nvidia to their stock price, so this means the company must be failing, right? We need to take a deeper look at the fundamentals to see if this is true. Over the long term, the company has expanded its revenue consistently into the double digits, which is very good for a company with its market cap in the billions. Growing revenue over 10% for a decade just shows the company is still producing. But what's the point of making a lot of revenue if there is no money left? Looking at the net income, S&P Global has tons of money after paying their expenses, and just like the revenue, it has grown over the year, so far so good for this company. What about the earnings per share? How much it is producing? As we can see, we have the same story as the previous metrics. A growing earnings per share means the company is still growing overall. So what's the problem with this company in particular? If it's growing, then why is the stock price is not going up? And I think I found the answer, and we can see it in the capital expenditure. When capital expenditure increases, then the free cash flow of the company decreases, scaring investors away like the company will go bankrupt or something. But where that money is being spent on? S&P Global is buying with intelligence for $1.8 billion. This is a company focused on private market data, insights, and analytics, the same as the S&P Global business model. So this means they're expanding their moat, but at the same time reducing competition by acquiring a company in their same sector. These type of acquisitions makes the company lag for a while until the acquisition is finalized and the company stabilizes. But wait, isn't big tech spending billions of dollars into AI infrastructure and their AI models? So if big tech is spending more and more in capital expenditure, isn't it supposed to see their stock price tumbling down? So are we in a bubble, or companies like S&P Global are being mispriced? Companies that just like big tech are growing their fundamentals in every single aspect, yet their stock price remains relatively flat. Is it one thing, the other, or is it actually a mix of both things? I think it's a mix. Focusing on the video's topic, just like S&P Global, there's tons of companies that are fundamentally growing and expanding, but since they are not overusing the buzzwords and all focus are on Max 7, they're being left behind in terms of stock price gains. Companies with strong durable moats, high quality businesses, and growing fundamentals that deserve a better stock price. On the other hand, we have companies literally generating no revenue, with their stock price rising up with no fundamental increase or moat, just pure speculation of what they could do and not what they are doing right now. So that will be it for this video. Make sure to subscribe, and remember, this is not investing advice. Make sure to analyze the stocks with due diligence, and as usual, thanks for watching, and I'll see you in the next one.